All right, let's dive right into this explainer. We are going to uncover the boring blueprints used by everyday people to build literal empires, all while Wall Street just looked the other way. I'm talking about the quiet millionaire's playbook. You know, we live in this crazy era where everyone is desperately trying to find the next crypto moonshot or the next tech unicorn or some super complex algorithmic day trading setup. But here's the honest truth. Generational wealth isn't usually built on a roller coaster. No, it's built in the background. It uses incredibly boring but highly effective tools that the financial industry has basically spent the last 50 years trying to make you forget. So today, we're going to expose the exact 20 asset classes that quietly generate massive fortunes. Let's get into it.
To really understand how this works, I want you to picture a man in a frayed flannel shirt named Ronald Read. Ronald was a gas station attendant and a part-time janitor at a JCPenney up in Brattleboro, Vermont. Just a regular guy, right? He chopped his own firewood, drove a secondhand car, and get this, he never earned more than about $25,000 a year in his entire life. In fact, when he walked into his local diner, people would sometimes actually pay for his breakfast because they just assumed he was flat broke. But when he passed away in 2014 at the age of 92, he left his entire town in absolute shock.
Why? Because he amassed an $8 million fortune. $8 million. And no, he didn't win the lottery, and he absolutely didn't inherit a dime. He ended up leaving the bulk of that money to his local library and hospital. So how on earth did a janitor pull this off? Well, he used a financial trick that was practically erased from public schools way back in 1971. You see, back in the day, schools actually taught practical household finance. They taught how compound interest worked, how to read a basic bond prospectus, and how to build wealth slowly. But when that curriculum just vanished, it created this massive vacuum, and Wall Street happily stepped right in to sell complexity. Ronald Read, though, he just stuck to the old school blueprint.
Which brings us to section 1, the core 3 pillars, boring wealth versus the Wall Street casino.
So Ronald Read's absolute primary weapon was the DRIP, a Dividend Reinvestment Plan. This is essentially a mechanism that cuts out the middleman entirely and forces your cash flow to just breed more cash flow over decades. Instead of getting a tiny little cash dividend sent to your brokerage account, which, let's be real, you'd probably just end up spending on a fancy coffee, the company automatically uses that dividend to buy you more fractional shares of their own stock. And the best part? There are usually zero commissions. It is totally frictionless. You're basically setting up an automated machine where your shares buy more shares, and then those new shares pay more dividends, which then buy even more shares. It's literally exponential compounding on autopilot. And man, this brilliantly illustrates exactly why DRIPs work so well. Take a look at this breakdown of the S&P 500's total returns between 1928 and 2025. Over 2/3 of the market's entire total return came strictly from reinvested dividends. Not just the stock price going up, but the dividends. Just let that sink in for a second. If you ignore dividends, you are literally missing out on roughly 66% of your potential wealth. Even during the notorious lost decade from 2000 to 2009, when stock prices were actually going down, investors were reinvesting their dividends, were still quietly building their wealth. Why? Because those dividends were buying up more and more shares at cheaper and cheaper prices.
Now, I won't lie to you, it takes immense patience to pull this off. But take the story of Grace Groner. She was a secretary who bought just 3 shares of Abbott Labs for about $180 way back in 1935. She held those 3 shares and she just reinvested the dividends for 75 years. By the time she passed away in 2010, that initial $180 investment had grown into $7 million. It's wild, right? But she absolutely proves that time in the market, combined with the quiet compounding of DRIPs, completely destroys the idea of trying to time the market. Moving right along, let's look at section 2, pillar 2, whole life insurance banking.
Okay, so by structuring a mutual whole life policy correctly, you can actually build a highly liquid, non-correlated private banking system. People often call this the infinite banking concept. And here is how it actually works in practice. First, you overpay your premium using something called paid-up additions, or PUAs. This is crucial because it turbocharges your cash value really early on. Second, that cash value grows tax-deferred at a guaranteed minimum rate, plus you get dividends from the mutual insurance company. And third, and guys, this is the real superpower here, you can borrow against your own cash value completely tax-free, up to 90%, and you never even have to ask a bank for permission. And while you're out there borrowing that money to, let's say, buy a piece of real estate, your entire cash value just continues compounding exactly as if you never even touched it.
What's really fascinating here is the consistency. Notice these 15-year average dividend rates. You've got Mass Mutual sitting at a solid 7.14% and Penn Mutual at 6.13%. Now, think about the S&P 500 for a second. It's incredibly volatile, right? It can crash 30 or 40% in a really bad year. But these mutual companies, they have been paying out steady 6 to 7% dividends straight through multiple economic crashes. By using this strategy, you get to keep the spread between your borrowing rate and your compounding rate. You are effectively becoming your own bank.
Next up, Section 3, Pillar 3, Series E Savings Bonds. Let's take a look at the mechanics of these things. These incredibly unsexy pieces of paper did something absolutely vital. They removed human emotion from the equation entirely. You bought them at exactly 75% of their face value, and usually it was set up to automatically deduct right out of your paycheck, so you never even saw the money. They were backed by the full faith of the US government, they were guaranteed to double over 20 years, and get this, they could accrue interest for up to 40 years. But here's the real kicker. There were severe penalties if you tried to cash them in early. They essentially acted as a forced savings mechanism, protecting everyday savers from their own worst impulses. You literally couldn't panic sell them during a recession. You just held them, and they quietly, dependably grow.
All right, Section 4, 17 more forgotten wealth builders. Let's rapid fire through the rest of these.
We promised you 20 assets, so let's keep going. These next 5 rely heavily on exploiting tax advantages and direct corporate or government discounts. We're talking about employee stock purchase plans, which give you a guaranteed 10 to 15% discount on your company's stock, or health savings accounts, providing this amazing triple tax-free compounding from medical wealth. Then you have Series I savings bonds for zero principal risk with guaranteed inflation protection. Direct stock purchase plans give you commission-free investing straight from the transfer agents. And municipal bonds offer tax-free income that literally funds 2 centuries of local infrastructure. So rather than paying middlemen, these tools essentially give you a free cost basis and rock-solid protection from the IRS. It's all about insulating your wealth. Moving on to numbers 9 through 14, the theme here is physical reality. We're looking at farmland, which gives you non-correlated income from crops while the land itself quietly appreciates, and timberland. Trees literally undergo biological growth regardless of what the Federal Reserve is doing with interest rates. Then there are royalty trusts for passive 6 to 10% yields from oil patents or mineral rights. Private mortgage lending lets you literally become the bank, lending out at 8 to 12% backed by actual property. Fixed immediate annuities offer guaranteed lifetime income that beats stock longevity risk. And cash value life insurance provides tax advantage growth way beyond just whole life if you structure it perfectly. The crucial takeaway here, hard physical assets and direct lending give you massive uncorrelated stability while the whole casino economy is out there panicking.
Rounding out our list of 20, we have these complex structures that generate huge yields precisely because they're so boring that mainstream traders just stay away. Real estate limited partnerships offer pooled private capital with great depreciation and cash flow. Master limited partnerships act like tax-advantaged toll roads for infrastructure. Preferred stocks are these high-yielding hybrid securities that sit right senior to common stock. Closed-end funds at a discount let you basically buy a dollar's worth of assets for 85 cents with an amplified yield. Peer-to-peer lending disintermediates the banks entirely, so you collect the interest spread directly. But ultimately, look at number 20, your own business. Sweating it out to build equity through your own labor and direct ownership. That is exactly how the vast majority of real millionaires are actually made. Which leads us perfectly into Section 5, the pattern break, exposing the fee machine. Okay, so if these 20 assets are so incredibly powerful, why has Wall Street spent the last half-century telling you they're outdated? Or worse, calling them flat-out scams? Well, the uncomfortable truth is that the financial industry simply cannot monetize your patience. Boring wealth thrives on zero commissions, holding for decades, and direct ownership. There is literally no middleman to pay. Now, look over on the right. Wall Street's entire model relies on extracting 1 to 2% annual assets under management fees. To justify taking that cut, they have to promote frantic trading, constant portfolio rebalancing, and just totally manufactured complexity. I mean, think about it. If they told you to just buy a solid dividend stock, turn on a DRIP, and go to sleep for 30 years, they would go out of business tomorrow. And guys, please understand, those fees are not just pocket change. A seemingly tiny 1% annual fee on a $500,000 portfolio, that will quietly bleed roughly $300,000 in compounded returns right out of your pocket over 30 years. Let me repeat that, because it's insane.
$300,000. That's a whole house. That is a fully funded college education. That is generational wealth being silently transferred away from your family's future straight into a financial institution's bottom line. The reality of the financial machine is pretty stark. Wall Street eagerly stepped into the educational vacuum created back in 1971 when practical household finance was systematically wiped from our public schools. They took the old ideals of wealth preservation and completely replaced them with a culture of pure speculation. Today, the median advisor charges 1%, and when you layer in mutual fund expense ratios on top of that, you are often paying up to 2% every single year. Yet the data consistently proves that the absolute cheapest, most boring index funds completely destroy expensive, actively managed ones over the long run. Wall Street is literally charging you a premium just to underperform. And that brings us to our final part, Section 6, the Ronald Read Mandate. Boring is beautiful, simple is sustainable, and patience is the only edge that never gets arbitraged away. The ultimate mandate we can take from Ronald Read's $8 million legacy is this: stop trying to get rich quick, stop guessing trends, stop trying to time the market, and stop paying so-called experts to do it for you. You need to start capturing wealth by owning productive, boring assets, and simply letting time and compound interest do all the heavy lifting. Ronald Read didn't try to outsmart Wall Street, he just completely ignored it. So, as we wrap up this explainer, I want to leave you with a really important final thought to chew on. Are you paying a massive premium for complexity, or are you finally ready to embrace the boring assets that truly build generational wealth? Listen, you don't need Wall Street's permission to set up a DRIP, or to look into private banking through whole life insurance, or just to buy a simple savings bond. The tools are all sitting right there waiting for you. So ask yourself honestly, whose wealth are you really building? Yours or your broker's? It's time to start small, start boring, and start today.